Hey folks, I'm Clayton Collins, CEO at HousingWire, and I have the pleasure of subbing in today for Editor-in-Chief Sarah Wheeler. Sarah will be back tomorrow, but I'm going to take the stage and get to interview Logan Mohtashami today. So our guest today, Lead Analyst Logan Mohtashami. We talk existing home sales, home prices, mortgage apps, all the good stuff. We tie it back to the knowledge that you need to excel as a housing professional. Enjoy the episode. So Logan, I don't know if you remember a couple of years back, Sarah and I got competitive and we set some goals. Who's going to win in the audience growth contest? HousingWire Daily versus my show, Powerhouse. Sarah, she's kind of taking the lead. But here we are today. I get to host HousingWire Daily. It's my first time hosting our HousingWire Daily.
You should have just asked me. I would have told you didn't stand a chance. So yeah.
Well, folks, all the followers of HousingWire Daily, I'm Clayton Collins, the CEO at HousingWire, and today I get to host this phenomenal podcast. Logan Mohtashami, welcome back to HousingWire Daily.
It is wonderful to be here, and we have a lot to talk about, as this is the second interview I'm giving today.
Hey, well, you are the charts guy, and we're going to talk numbers. Let's kick it off, Logan. Existing home sales. What do we see in the data?
Okay, so this is a very interesting report because I thought for the last 10 days, I'm trying to prep people that it's going to show actually some really solid year-over-year price growth, which is going to be shocking to everyone because, we still have people in America who think home prices crashed in 2023 and haven't rebounded. And in this context, just kind of, how I talked about in the article, year-over-year price growth data was actually negative last year on the existing home sales reports. It was rising on a month-to-month basis everywhere else, but because it's a median sales price report, it actually has a very low bar, and we're going to have a low bar, even a lower one in the next month's report. So it shows almost 6% home price growth, but I would argue that it is cooler than that. And also this data line lags. And this is one of the things that, I was trying to explain on Yahoo, that because we have the tracker data, and our tracker data is very live weekly, and it kind of looks out months before the existing home sales report comes in. Inventory this year started a little bit late, but it's starting to look like a very normal year. Like if you took 2020, 2021, 2022, and 2023 out of the equation, and you focus on how our weekly tracker inventory looks like in 2017, 18, and 19, it looks kind of like a normal year, except total active inventory is still low. So this is a positive. It's a positive that new listings data is growing, and that's the theme for 2024, because a lot of people didn't think inventory can grow with rates this high, and that hasn't been the case.
So when you talk about like that, in the beginning of the year, it looked similar to what we expected and what we've seen in past years. You're talking about this seasonal curve where in December, January, and February, we start to see inventory bottom out. But in March, we kick off the traditional home selling and buying season where inventory climbs up until what month do we usually see a peak?
Usually kind of in the summer, August, in normal times, or September. It's just after 2020, it's been very late. Even this year was somewhat late. We usually get the seasonal bottom in January, maybe February, and then we see the increase. Here was a little bit in March, but it's starting to look like a normal year. The only thing that isn't normal is that the new listings data, while it's growing, it's still not back to kind of the pre-COVID trend. I always like to give people some perspective. New listings data is growing year over year, still trending at the lowest levels ever recorded history. If we ever saw stress in the inventory, this data line would go vertical. And a good example was 2008 to 2012. The data lines back then were running at 250 to 400,000 per week. We're still in this 30 to 90K level range. So I had hoped for a little bit more new listings data growth. We're almost, the Memorial Day weekend, you're going to see a dive in that data and then a rebound. But it doesn't look like I'm going to get what I want, but still a positive story. Active inventory is growing, new listings data growing. There's more choices for people. This will cool down the price growth. And we kind of just have to figure out a way to cool down prices enough to eventually, at some point, mortgage rates, when they fall, we have a little bit more inventory base to work off from, so we don't have to worry about, getting back down to March of 2022 when we had only 240,000 single family homes available for sale.
So you mentioned that existing home sales is kind of like the lagging indicator. If we're to think about the order of operations, the indicators of different points in the cycle, Would you say new inventory would be kind of like the lead indicator? Inventory is like next, and then existing home sales is kind of the final score?
Yeah, you know what? With our data, the new listings count is the homes that come to the market that don't get a contract, and our pending contract data is actually showing a little bit year-over-year growth the entire year,
Yeah.
and I attribute that to the actual new listings data growing. We don't see that in the purchase application data. Purchase application data has been down double digits pretty much year round. So I think people had thought they take that survey literally. So they think that existing home sales should be down like 3.3 or 3.4 million. That's just a trend survey. We're pretty much stuck at the low levels of the 1990s. But the fact that new listings data is growing and then the pending contracts on a year-over-year basis is growing shows that we have more sellers that are buyers this year. We don't have mortgage demand growth like we've seen in the previous decade or 2020 or 2021, but we have a little bit more sellers that feel comfortable enough to buy. It gives us a little bit better demand for this year, and we'll see how the rest of the year looks like, depending on where mortgage rates go. But considering everything that we've been through, and with rates still where they are, this is as good as you can possibly get. Again, for me, it's always the fear of home prices escalating out of control. So the faster we cool down prices, the better. By now, everyone should realize national home prices aren't crashing. We just don't have that kind of marketplace. So I welcome the active inventory. I welcome the new listings data. The price cut percentage is slowly going to grow. But our data is earlier than everyone else's. So you can get a heads up by just following Mike and myself on HousingWire.
Yeah. So Logan, so on this week's Altos data, we saw that home price cuts continue to climb. So like we're at 34.4% of listings have had a price cut. This is up from, I don't remember the exact number, but like a 20 handle last year. Let me look at the number real quick. It was 29. It was in just beneath 30% at this point last year. So we've climbed up close to 5 points.
Yeah. And a good point on this is that last year, the unfortunate reality is that new listings data was trending at the lowest levels ever recorded in history, right? And also when rates fell down toward the end of 2022 and mortgage demand picked up, the seasonal bottom didn't happen until like April 14th. So we started the inventory growth later. So everything is seasonal with housing data. Inventory grows, price cut percentages increases, and then you see the decrease later on in the year. So the fact that we were able to start inventory growth earlier means that we were working from very easy comps to show year-over-year growth. And then as the year goes on, those comps will get harder. But the fact that we're having a functioning marketplace with more supply, to me, is the positive story. We didn't want what we saw in 2023 to happen again. I think that was the whole concern of the mortgage rate lockdown, that there's no way inventory can grow. There's no way new listings data can grow. Nobody's going to sell their 3% mortgages, even though every single week for almost 2 years, people are selling their low mortgage rates to buy other homes. And in this case, this is the best we could hope for with all the other variables that are in place right now.
Yeah, no, talking about people actually listing their 3% homes, we just dropped and I know you guys have talked about on the podcast, we dropped a white paper that was authored primarily by Mike Simonson on the mortgage rate lockdown theory. I did a webinar last week for HousingWire members. I think that's going out now to the rest of our audience. You can find it on the research tab of housingwire.com. Pretty phenomenal research, Logan. Did you enjoy that one?
Yes, and the interesting aspect is Mike and I are not mortgage rate lockdown people. We also have a different way of looking at this, where my models are based on the entire housing ecosystem change after qualified mortgage, right? And, when we look at the NAR data going back to 1982, we've had these inventory, not surges, but increases in previous decades. And then we had an ultimate surge from 2005 to 2007. And that all changed, kind of after 2010. So because the credit markets are different, meaning that from 2000 to 2005, existing home sales were booming, but active inventory was growing too. The credit markets facilitated a lot of sellers that could be buyers and everyone could freely list their homes. They're not, in a sense, locked down by the credit, right? The credit means that you can only sell and buy your house when you qualify, right? That was the whole premise of the qualified mortgage in 2010. Everyone's legit. So the ability to move freely like people did in the past is over, right? So it's just a natural flow of buyers. So I think Mike and I have a different take on this, but it's kind of the same premise. When rates go higher, like we saw in 2022, we saw inventory grow. We see inventory grow here as rates are staying higher. We saw this in 2014 as well. So higher rates just means that the days on market can grow. It takes longer to sell, but it is the only way that we've seen in our data that inventory grows. This is why Mike and I are very adamant about this, because it's the active inventory everybody looks at, right? When rates fall down, demand picks up, you get more sellers that bring that inventory, because then they become buyers, and that home doesn't allow inventory to grow as much. So from my point of view, we're very adamant about the mortgage rate lockdown. Mike and I have just a different take on it, but I think a lot of this has to do with the credit markets have changed after 2010. And we see this year, right? It's inventory is up 36% year over year, but it's up well over 100%, because in March of 2022, we only had 240,000 single family homes. Today, after last week, we have 570,000. So it's not a lot, but it's a step, right? The NAR's data has about 1.21 million. I'll be so much more comfortable with the housing market if that data line gets into a range between 1.52 to 1.93 million. It's as close as we get to kind of pre-COVID. And that means more choices, less price growth, not anywhere close to the savagely unhealthy housing market, but a functioning normal marketplace.
Yeah. So Logan, on the topic of home prices, last week there was an article from the Wall Street Journal making the rounds with the headline, Florida and Texas show signs of home prices falling. Robust home building activity in recent years has helped boost the number of homes for sale. So this article lands in my inbox by some people who were probably a little too scarred by 2008, 2009. And any talk of decreasing home prices in Florida specifically brings fear and angst and like this bubble-ish view on real estate. We know how you feel about the bubble boys, so I won't get you started there. But bring some context to how you think about flattening home prices, potentially home prices that are even down a point or two, and rising inventory, what that means for the mortgage and real estate professional.
So any kind of factor that cools down home price growth is a positive, right? That's kind of my thing. It's just that it was almost the opposite thing we had to worry about. We had to worry about kind of like a melt up in prices, not a crash. And what happened is that this is my take, is that not a lot of people in America actually track housing data. So nobody actually knew how low inventory was. So when you have too many people chasing too few homes, prices can escalate out of control. This was the whole team higher rates in February of 2021, where people thought, you're crazy, forbearance. So I said, no, we don't have to worry about that kind of credit market, but we do have to worry about home prices escalating out of control. And the reason I say this is that it's very sticky and hard, the history of nominal home prices falling on a national level. And in this regard, God, I'm so happy to see inventory grow. I'm so happy that we are getting some kind of inventory growth from higher rates. But what we don't see is escalation inventory or stressed inventory, right? And the new listings data shows us that. So I would always tell people to follow the new listings data. If you ever see stress in the marketplace, you'll see it there. Now, Florida, I would say a little bit different. Florida has a unique situation there where people talk about the climate change situation in terms of insurance costs, but the condo market there has assessment issues, right? So you have a lot of retirees who are kind of like in a fixed income kind of state. And then all of a sudden, their cost of housing goes up a lot. So it takes away the, like I always say, 30-year fixed mortgage, fixed debt cost, rising wages. So the Florida condo market to me is the number one ground zero to take a look at. Texas, on the other hand, Texas is a very expensive marketplace in relationship to the demand, but it has property taxes and insurance. But Florida to me is ground zero on how much does the insurance cost and the assessment cost impact there. Louisiana is another place where we're actually seeing year-over-year declines there, where we have a lot of weakness demand, and also the cost of housing is much higher there than other places just because the insurance cost goes up. So there are pockets of the country where you see this kind of weakness, where Texas and Florida and Louisiana, and they're a little bit different than I would say the other countries. And hopefully this explains why national home prices are still up, but you still have pockets of the country seeing weakness.
Dips in regional. I mean, even with like the stress on the Florida condo market, I still saw that Wall Street Journal headline and read it with excitement. Like, this is a good thing. We needed prices to flatten. We need inventory to build. But if you're not in the industry tracking the data, it's very easy to misconstrue a headline like that with fear. I do think that you brought up a really good point on the difference between the traditional existing home, single family, and condo. And we should, and I know this is a simple toggle in Altos. Like, we need to do a report breaking out performance trends between condo and single family in Florida. That feels like a really, like, it's at our fingertips data, easy report that would be pretty insightful.
Yeah, I've actually taken a look at the condo and Florida markets internally. So yes, there is a divergence in there. There's a divergence in few parts of the U.S., and then there's other places of the country where you just have normal seasonal inventory growth. So there are pockets, and the key is always to find out why, right?
Yeah.
The why is the more important than the final answer. Right? People like to say the final answer before it ever happens without doing the detective work, right? And all this is happening with home sales still at record lows. So the reason I'm very pro inventory is, what if rates fall? That's what happened at the end of 2022, right? Everyone was full on in the home price crash at the end of 2022. Rates were falling then, and all of a sudden the forward-looking demand picks up, and everyone's like 6-7 months later, they're like, oh my God, why are your home prices crashing? This is why the weekly tracker is the most efficient way to track forward-looking data, and the key, because there are going to be turns in economic cycles, right? And especially in the housing cycle, but we have the ability to track it faster than everyone else. So we know when, you'll see it. And this is why I'm trying to tell people, let's be cautious about the almost 6% year-over-year price growth. Comps are very low. We're going to have another low comp next month for the existing home sales report. And then the comps get harder and the price growth is going to cool down. So you have a double whammy effect. We should get a deceleration of price growth in the second half of 2022 or 2024, a positive in my eye for housing.
So, Logan, we're recording this on Wednesday afternoon. It'll drop on Thursday morning. But today, Wednesday, we woke up to, after several weeks of mortgage rates actually cooperating a little bit, we saw a little pop in application data. Tell us what you're seeing on the mortgage side.
We're seeing a lot of refinance action pick up recently.
That's wild to me, but we're still at 7%. Who is the 7% refi applicant?
Well, it depends if they're getting that 7%. So a hypothetical theory, let's say you locked in at 7.75, in 2023, and somebody's offering you 6.625. Do you take that? For a homeowner, like, okay, so pricing is of course different for everyone, but we do see refinances pick up. Now, again, we are working from the lowest bar ever. Like, people were on Twitter like, oh my God, look at the refinance index. And then if you take the chart out like 2 decades, you're still basically at the all-time or near the all-time lows. But you get a little bit pickup in demand. On mortgage purchase application data, we don't see that as much. We're seeing pretty much just flat to slightly down on a week-to-week basis. We're pretty much not going anywhere for a while now. What we do see with purchase application data and rates is when rates fall 1% or more, then the data has a series of weeks of gains. We saw that at the end of 2022, which brought us 12 weeks of positive data. That took mortgage rates down to 6% for that to happen. In 2023, we had rates come down 1%, but over 1%, but we only had 8 weeks. So mortgage demand is still pretty much, to me, at all-time lows. But the refinance data is picking up a little bit more. And again, the spreads are getting better this year. That's really key. I didn't think the spreads would get better until we were really sure about when the first rate cut was happening. But I could tell you this, if I took the worst levels of the spreads last year, it's 0.5% higher in mortgage rates today, right? So it does make a difference that the spreads are. If the spreads get better with the 10-year yield falling, okay, then you got a double whammy positive effect. That brings you to the low 6s and a 5 handle at that. Then you have something going with the existing home sales market, because the builders have shown you the way. You get sub 6% mortgage rates, you get buyers into the game. But again, I'm a little bit surprised how good the spreads are as of now. I would really think that It would have been more evident to everyone once we were sure about the first Fed rate cut. Not quite there yet on the rate cut story yet, but the spreads are acting better. And I thought that was the big main negative housing story last year, is that after the banking crisis, the spreads got worse.
So, Logan, I just opened up the HousingWire Mortgage Rate Center, which we publish with data from our partner, Poly. And looking back, October 31st was the high point in the Mortgage Rate Center at 7.88 for 30-year conforming. So, yeah, that's over 6 months ago. I'm starting to think about EPO risk here. So 6 months ago, at the end of December, we were at 7.6, and we came back to that 7.6 level at the beginning of May. So just a few weeks back. So what do you think about on the EPO risk side? Like, is payoff going to be a headache for originators, for mortgage bankers, for capital markets? Like, how do you think about that?
So, I always harken back to the first Monday morning of COVID, March 9th. And the first thing I tweeted is mortgage market meltdown. I just thought literally 90% of the loans in play are all EPO risks, right? That was a complete nightmare scenario. Not a lot of people understand that early payoff risk, the margin and hedging on that. Not the case here as much, but I would tell you that the EPO risk is, you can see it in the spreads being still 1% or 75 basis points to 1% higher than what they would normally be, right? So there probably are a few EPOs going out there, but nothing too big. The move has been slower, going up and going down now. So we're working with a little bit different equilibrium, unlike what we saw kind of back in March of 2020, where it was just a straight waterfall, right? And it was such a waterfall dive in rates. And literally by the end of the week, rates went up 1% because literally the system was breaking back then. So we don't have that kind of stress, but I would say that the EPO risk is being priced in, that we still are 75 basis points to 1% higher than what we normally would be.
I think anybody who profits or does business on volume is kind of rooting for that 6 handle. But I can pound the table and say consistency is our friend. It'll help pricing. It'll help our industry be healthier. It's the shock and the volatility that hurts us.
And this is why I think that we have a little bit better spreads this year. That last year, the banking crisis just shot the spreads up higher, right? We were actually trending good in 2023. Then March came, and then the Silicon Valley banking crisis went up, and then that happened. So in this case, I think that's the best way I could explain why the spreads are better. There's a little bit more stability in mortgage pricing this year. And even though the Fed hasn't started the rate cut cycle and the 10-year yield hasn't, gone into the really economic weakness mode, we have better pricing. And again, if I took the worst levels of the spreads last year, remember the spread numbers are different for everyone else depending on who you quote. That's 0.5% higher right now than where we are. So it's a positive story this year, and a positive story with inventory. So I'm so much more happier in 2024 than I am in 2023. 2023 is like, oh my God, record low levels of sales. Home prices are up 6%. New listings data trending at all-time lows. That's not a good housing market.
We can see the happiness in your on-air appearances. So in the last week, Logan, you had the big primetime CNBC Squawk Box appearance on Friday. Today, you had the Yahoo Finance interview. Is there anything that we missed in our conversation that you talked about on air that we should add to this episode before we call it a day?
Three national interviews within 7 days. But I would say this. One of the things that I see talked about a lot, maybe on other networks, is this notion that it's inventory holding sales back. And I do not believe that's the case. I believe it's affordability and rates. Inventory is growing this year. Okay, so we have more active listings, more new listings data. So the total sales not being able to grow is a function of mortgage rates are too high. If mortgage rates are down at 6%, we've tested this at the end of 2022. What happened? We had 12 weeks of positive purchase application data. We have more sellers that are buyers, but we don't have that growth in sales. And it's not inventory. I've actually heard this for like 10, 11 years, that there's just not enough homes. Okay, demand is holding it back right now. Trust me, if rates just went down to 6% right now, home sales would be rising. And this goes back to
as would prices, which would be like a whole nother headache again.
Yeah, it would. I would argue we don't have to worry about what we saw in 2020 and 2021 because that was a kind of a sub 3.5% mortgage market, and active inventory was so much lower back then than it is now. So we have more supply and higher rates, and affordability is still an issue. So we won't see the savagely unhealthy housing market where 78% of the homes were getting multiple bids in that sense. So in this context, I think it's a good thing that inventory is growing. And then whenever they do fall, we have a buffer. And that's what I've always wanted. I've always wanted 2019 levels. This is why I like Florida and Texas. I love those markets, right? Because they have a buffer. Because I can't assume that we're going to have 20 years of the lowest home sales ever recorded in history, because all it took was 6% rates to grow demand. So in that context, if the economic data starts to get weaker and the 10-year yield falls and the Fed cuts rates and everything like traditional economic cycles, now we're in a little bit better place than we were 2 years ago. And the reason I always like to bring up the active inventory story is that in 2020 and 2021, active inventory was pretty much at all-time lows, and we had more home sales in 2020, 2021, and the first part of 2022 than any part of the previous decade when we had higher active inventory. So this is the complicated housing economics discussion where I don't believe it's active inventory holding. And demand is a function of sellers or buyers. You go in there, we close transactions much faster now. So this is why when rates fall, inventory stays flat or goes lower. So we right now have the inventory. There's more choices out there, but rates are too high. And if you look at it in that light, 2020 could be explained, 2021, and the early part of 2022, and then rates skyrocket up, inventory grew, demand fell, and we're just hovering here. This is year 3 of the lowest home sales ever recorded in history. And I say that, and I'm not joking, because we have over 158 million people working. We have 342 million people population-wise. So when you take it in that context, we're at very low levels. It doesn't take much to move the needle, right? So I feel better that there's more supply and we don't have to worry about a rush of people buying too few homes. And then here we go again, back 2020, 2021 data and early 2022.
So on the topic of national interviews, I have to poke fun a little bit, Logan. Did I catch one of the interviews right that you may have been introduced as HousingWire's lead analyst, Logan Mohtashami?
Yeah, something like that. You know, it's funny. I've known Leslie for a very long time. She knows how to say my name. So she just literally
something. It was good.
She had a brain freeze. So she just said, "Oh, I saw what was there. I just didn't read it." So listen, my last name has been butchered many times over the years. So Moto and then Shami, like that guy that was selling that Shami thing, you know, back in the 1990s. So it's easy if you think about it in that line.
I'm just thinking about what sandwich we can name after you. Pastrami is it's a good one. All right, Logan, thank you for joining me today. Folks, that's a wrap on HousingWire Daily. I'm Clayton Collins. Check out Powerhouse. That's the podcast I host. Since Sarah Wheeler gave me the reins today, I'm going to plug my show, Powerhouse. Each week I interview.
Everyone come to Clayton's podcast. Help boost up the numbers there so you can do it.
It's not like I'm struggling. I got thousands of listeners every week. I interview new CEOs from across the mortgage and real estate industry. I don't have Logan Pastrami on as frequently as Sarah does, but maybe we should fix that.
Yeah.
All right, folks. Sarah Wheeler will be back tomorrow. Have a great day.